Something changed before most people even noticed the rule was changing. There was no loud debate, there was no national warning, there was no simple letter sent to retirees explaining that the old way of moving money had become much more complicated. The system changed quietly, and that is usually how important systems change. In the last few years, the rules surrounding the old $10,000 bank reporting threshold have become broader, faster, more automated, and more dangerous for ordinary people who are not trying to do anything wrong. That is the key point. This is not a story about criminals trying to hide money. It is a story about normal Americans, especially retirees, trying to use their own savings in a world where the reporting system was built for one era and is now being enforced in another. When a system is designed around an old number and the world around that number changes, the system begins to produce strange outcomes. It catches people it was never meant to catch. It creates incentives for institutions to protect themselves rather than serve the customer. And it turns ordinary financial behavior into something that looks suspicious to a machine. That is what is happening. Now, the $10,000 rule most people think they understand is not the same rule they are living under today. What used to be a narrow cash reporting rule has become part of a much larger surveillance and compliance structure. It touches bank withdrawals, it touches deposits, it touches repeated transactions that fall below the threshold. It touches crypto platforms. It touches Zelle, Venmo, Cash App, and PayPal. It touches contractors, car dealers, attorneys, and businesses that receive significant payments. It touches the retiree who wants to buy a used car, fix a roof, help a grandchild, pay a medical bill, or move money after a spouse dies. And the most dangerous part is that many people who trigger these systems never realize they have triggered them. A report may be filed and they may never see it. A review may begin and they may never understand why. A withdrawal may be delayed and the bank may describe it as a processing issue. A pattern may be flagged even when the money is clean, the purpose is legitimate. And the person has no intention of hiding anything. This is why I want to walk through the system carefully, not emotionally, not politically, not as a scare story. I want to look at it the way I look at any system that creates risk. I want to look at the incentives, the rules, the feedback loops, the thresholds, and the human behavior that gets people into trouble. Because if you understand the system, you can operate inside it much more safely. If you do not understand it, you can be completely innocent and still create a problem for yourself. The first principle is simple. When the rules are automated, your intention matters less than your pattern. That is hard for people to accept, especially older people who grew up in a world where a relationship with a local banker meant something. They think, I have been with this bank for 40 years. They know me, they know I am not a criminal, they know I am not being manipulated, they know this is my money, but the modern banking system does not begin with personal trust. It begins with compliance software. That software looks at what you normally do, compares it with what you are doing now, and decides whether the deviation requires attention. If you normally withdraw a few $100s and now you want $10,000 or $20,000 or $40,000, the system does not ask whether you are a good person. It asks whether the pattern is unusual. If it is unusual, the bank has a new set of incentives. If the bank releases the money and you are being exploited by a scammer, the bank may face liability, reputational damage, regulatory attention, and legal trouble. If the bank delays your withdrawal and it turns out you were perfectly fine, the bank usually suffers very little. So the incentive is not balanced. The incentive is to delay first and apologize later. That is one of the biggest changes ordinary retirees are now facing. To understand how fast this can become real, think about Martin and Carol. Martin is 71, Carol is 68. They live outside Phoenix. They are not rich people, they are comfortable people. Martin worked for decades as a regional manager for a paper distribution company. Carol spent her career as a registered nurse. They did what responsible people were told to do. They saved. They avoided unnecessary debt. They tried to live within their means. Last October, they decided to replace Carol's car. They did not want a big loan. They did not want a complicated financing arrangement. They negotiated the price to $40,600 out the door. And Martin went to the bank the next morning to withdraw the money. In the old world, that would have been simple. A man goes to his bank, he withdraws his money, he buys his wife a car. In the new world, the transaction looked different to the system. Martin gave the teller the withdrawal slip and sat down. Then a branch manager came out and asked him to step into a private office. The manager wanted to know why he needed so much cash. The manager wanted to know whether anyone had instructed him to withdraw it. The manager wanted to know whether he had received any phone calls, emails, or text messages telling him to send money. The manager wanted to know whether he had met anyone new online. You can see the logic from the bank's side. Elder fraud is real. Scammers do pressure older people into withdrawing money. Banks have been told to watch for those patterns. But you can also see the humiliation and loss of control from Martin's side. He was a competent adult. He had no cognitive impairment. He had saved the money. He had negotiated the purchase. He wanted to buy his wife a car. Yet in that moment, his own bank treated the transaction not as a normal act of ownership, but as a possible risk event. After Martin convinced the manager that the dealership was legitimate, the bank still delayed the withdrawal for 72 hours. He had to go back to the dealership and ask them to hold the car when he finally received the cash. He thought the matter was over. It was not over. Within about 30 days, Martin received a letter telling him that a suspicious activity report had been filed related to the withdrawal. That report sits inside a federal database and can be cross-referenced against future activity. Martin did not commit a crime. He did not try to hide money. He did not fall for a scam. He wanted to purchase a car. And that is why the story matters. It shows how a rule that appears to be aimed at bad actors can create friction for ordinary people when the system becomes more automated and more defensive. The root of the problem is the number itself. The $10,000 threshold comes from the Bank Secrecy Act of 1970. That date matters because money had a different meaning. Then in 1970, $10,000 was a very large amount of cash. A gallon of gas cost a small fraction of what it costs today. A median home cost a fraction of what it costs today. $10,000 could buy major assets. For many people, it represented more than a year of income. The threshold was designed in that world, but the world did not stay there. Prices rose, wages rose, medical costs rose, homes rose, cars rose, repairs rose, retirement balances rose. The normal financial life of an ordinary family became larger in nominal dollars. The threshold did not move. That is the central mismatch. If the threshold had been indexed to inflation, the amount that triggered reporting would be far higher today. Instead, the number stayed frozen while ordinary transactions grew around it. A kitchen remodel, a car purchase, a medical payment, a lump sum distribution, a family gift, a contractor payment, a legal retainer, an insurance payout, a transfer after the death of a spouse. These are no longer rare events that only criminals or very wealthy people encounter. They are normal retirement transactions. So the system that once looked for extraordinary cash movement now touches ordinary life. That is how an old threshold becomes a modern trap. The first major way this trap shows up is in senior withdrawal delays. Banks have been pushed to detect and prevent elder financial exploitation. That objective is reasonable. Elder fraud is a serious problem. But when you combine that objective with compliance software, legal immunity, and institutional fear, the result is predictable. The bank has a strong incentive to pause anything that looks unusual. What counts as unusual? Not necessarily fraud, not necessarily coercion, not necessarily a scam. Unusual can simply mean that the transaction is different from your normal pattern. If you usually take out $300 a week and suddenly request $20,000, the system does not know that you are buying a car. It does not know that your contractor wants payment. It does not know that you are paying a medical bill. It only sees a deviation. Then the human review begins. That review can take hours. It can take days. In some circumstances, it can take a full 72-hour banking window during that time. You may feel as if your money no longer belongs to you in the practical sense, even though legally it does. And the bank may not explain the real reason in plain language. It may say compliance review, it may say processing issue, it may say verification. The words matter less than the incentive behind them. The bank is protecting itself from the possibility that you are being exploited. The cost of being wrong in one direction is high for the bank. The cost of being wrong in the other direction is low. So the system leans toward freezing. That is not because every banker is malicious. It is because systems follow incentives. When you understand that, you stop taking the delay personally and start preparing for it practically. The second trap is structuring. This is where innocent people can put themselves in danger by trying to be clever in exactly the wrong way. The rule is that you cannot break deposits or withdrawals into smaller amounts for the purpose of avoiding the $10,000 reporting requirement. The money can be clean, the purpose can be clean, the transaction can be completely legal. But if you intentionally divide it into smaller pieces because you want to avoid a report, you have created a serious problem. That is difficult for many people to understand because they think the crime must be hidden in the source of the money or the use of the money. But in structuring, the problem is the pattern and the intent behind the pattern. If you have $12,000 to deposit and you deposit $6,000 today and $6,000 tomorrow because you think staying under $10,000 is safer, you may actually be making yourself look much more suspicious. A single $12,000 transaction may trigger a routine report, A broken up pattern may trigger a structuring review. Those are very different risk profiles for decades. Obvious structuring meant deposits just under the line. 9,000, 9,500, repeated again and again. That was easy for banks and regulators to see. Now the pattern detection is more sophisticated. Amounts do not have to sit right below 10,000 to raise attention. Repeated deposits or withdrawals of 7,000, 8,000, 8,500, or other amounts can become suspicious if the timing and spacing suggest the person is trying to avoid the threshold. Again, the key point is pattern. A retiree might think, I do not want to bother the bank. I do not want to fill out paperwork. I do not want to make anyone suspicious. I will just split this up. That instinct can be dangerous. The safer principle is often the opposite. Do the legitimate transaction openly. Let the routine report happen. Do not create an artificial pattern that looks like evasion. Civil asset forfeiture makes this even more serious. There have been documented cases where people had money seized under structuring theories even though they were not charged with crimes. Small business owners, farmers, grocery operators, convenience store owners, people whose cash handling patterns were legal but looked wrong to the system. One family business had hundreds of thousands of dollars seized because deposits appeared to be structured. Others lost operating accounts and had to fight for the money. The point is not that every retiree will face that outcome. The point is that the system does not require you to be a criminal before it can make your life very hard. When a financial pattern matches the wrong profile, you may be forced to explain yourself after the fact. That is a very bad position to be in. Good decision-making is about avoiding bad positions before they happen. The third change is that digital payments are no longer outside the same broad reporting world. Many people still think of Venmo, Zelle, Cash App, PayPal, and crypto platforms as informal or separate from the banking system. That is an outdated mental model. The line between traditional bank reporting and digital transaction reporting has become much thinner. Crypto platforms now face reporting obligations that bring customer transactions into the tax and compliance pipeline. Large crypto transactions can enter the same type of federal reporting architecture that people used to associate with physical cash. At the same time, reporting thresholds for peer-to-peer and payment platforms have been moving downward. That matters because a threshold that was once high enough to catch more commercial activity begins to catch ordinary reimbursements, hobby sales, family payments, and small side income. A payment from a church for catering, a payment from a neighbor for a used item, a group dinner reimbursement, a grandchild sending money back for a family expense. Individually, these things may feel personal and harmless. In aggregate, they can create tax reporting forms that the Internal Revenue Service expects to reconcile. This is where many retirees get into trouble. They do not see themselves as operating a business. They see themselves as helping families, selling a few items, being reimbursed, or moving money conveniently. The reporting system does not always understand those human categories. It sees totals, it sees platforms, it sees forms, it sees mismatches. A mismatch does not mean guilt, but a mismatch can mean letters, questions, delays, explanations, and professional fees. So the principle is simple. Convenience without record keeping is dangerous when the platform reports to the government. The fourth problem is Form 8300. This is the form businesses must file when they receive more than $10,000 in cash or certain cash, like payments from a customer. Most ordinary people do not think about Form 8300 because they are not the business filing it. That is exactly why it surprises them. If you pay a car dealer, a contractor, an attorney, a jeweler, a real estate professional, or another business more than $10,000 in qualifying payment form, the business may have to report details about you that can include identifying information, the amount, and the nature of the transaction. The report goes into the system even though you may never think of the transaction as anything special. The penalties for businesses that fail to file correctly have become more painful, and electronic filing has become more central. That means the business receiving your money has a strong incentive to file accurately and file every time. This is not personal. The business is protecting itself. But the effect on you is that large transactions create documentation trails across more points in the economy. The detail that catches many people is aggregation. If related payments are part of the same transaction, splitting them does not necessarily keep them separate. If you pay a contractor $6,000 today and $6,000 next week for the same roof, the business may still treat that as one $12,000 transaction for reporting purposes. And if you split the payment because you believed it would avoid a report, you may have made your pattern look worse. Once again, the rule of the system is clear. Trying to avoid being seen can make you more visible. The fifth issue is not a single new law, it is the inflation cascade. This is the biggest underlying force because it turns a reporting threshold into a routine tripwire. A number frozen for more than half a century becomes smaller every year in real life. That means more normal transactions cross it. The average retiree may trigger reporting, review, or filing systems several times in a year without thinking of themselves as doing anything large. A car, a roof, a medical bill, a gift to a grandchild, a distribution from an account, an insurance check, a refund, a mortgage payoff, a home improvement in 1970. Many of these equivalent real dollar transactions would not have touched the system. Today they do. That is why the $10,000 rule feels much worse. Now it is not just enforcement. It is mathematics. The number stayed still while life moved around it. When systems are not updated for inflation, they silently expand their reach. That is one of the most important lessons in policy and economics. Sometimes a law does not need to change in words for it to change in effect. A frozen threshold can become a growing net. Now, understanding the risks is not enough. The practical question is what a careful person should do. The goal is not to hide. The goal is not to evade. The goal is not to outsmart the government. The goal is to behave transparently, document clearly, and reduce the chance that normal activity is misread by an automated system. The first protective habit is to talk to the bank before you move a meaningful amount of money. That sounds simple, but it is one of the highest leverage actions you can take if you know you will withdraw a deposit or transfer a large amount. Call the branch manager in advance. Explain the purpose. Ask them to note the customer file, tell them the approximate date, source of funds, and recipient. This does not stop a required report from being filed. It does something else. It gives the bank context before the software sees a strange pattern. Context is powerful. A transaction with no context can look like a risk event. The same transaction with a documented note can look like exactly what it is, a planned, legitimate movement of your own money. If Martin had called the bank ahead of time and said he was purchasing a car for $40,600 from a specific dealership, the bank might still have asked questions. But the odds of a full delay would have been lower because the branch would already have a record of the purpose. That is the way to think about this system. Do not wait until the machine flags you. Put the explanation in the file before the machine asks for it. The second protective habit is to stop accidentally structuring. If you need to move $12,000, do not break it into two $6,000 pieces because you think that is safer. It is often not safer. Move the legitimate amount in one transaction and accept that a routine report may be filed. Most reports over the threshold are not accusations. They are routine compliance events. Trying to avoid the report is what can create the dangerous pattern. If payments need to be separated for a real reason, document that real reason. Maybe the contractor completed work in phases. Maybe the invoice itself is phased. Maybe the transaction has a business or practical structure unrelated to the threshold. The key is that the reason should be real and documented, not invented after the fact. In a good system of personal finance, you do not rely on memory, you rely on records. The third protective habit is to use wires or traceable transfers for large transactions instead of carrying cash whenever possible. Cash is emotionally satisfying because it feels final and private, but in this environment, cash can create more reporting friction and more suspicion. A wire transfer to a car dealer, an attorney, or a contractor often creates a cleaner and more direct record. The recipient may prefer it because it reduces cash handling risk. You may prefer it because it creates a clear transaction trail and avoids some of the practical problems that come with large physical cash withdrawals. The principle is not that wires are invisible, they are not invisible. The principle is that traceable, purpose-specific. Direct transfers are often easier to explain than large cash movements. When a system is designed to detect suspicious cash behavior, do not unnecessarily create suspicious cash behavior. The fourth protective habit is to separate digital payment activity by purpose. This is especially important for retirees who use one account for everything. If personal reimbursements, family payments, hobby sales, rental activity, casual side income, and small business activity all pass through the same payment account, the totals can become confusing. At tax time, the platform may issue a form that mixes activity that should be treated differently. That creates the possibility of mismatches and explanations. A cleaner approach is to keep personal payments in one place and business or quasi-busyness activity in another. Do not mix everything just because the app makes it convenient. Convenience is not a record-keeping system. The fifth protective habit is to document large transactions before you need to defend them. For every transaction above a meaningful amount, write down the date, amount, source of funds, recipient, and purpose. A notebook can work, a spreadsheet can work better. The important thing is that the record exists at the time of the transaction, not after a problem begins. Contemporaneous records carry weight because they show what you were doing when you were doing it. If your pattern is ever questioned, a clean record can turn a suspicious-looking sequence into an understandable sequence. Without records, you are asking a reviewer to believe your memory. That is a weak position. With records, you are showing the reviewer the facts. That is a stronger position. There is also an advanced step that many retirees should ask their bank about, especially if they routinely make large, legitimate transactions. You can ask whether the bank has a senior safe banking authorization, trusted contact arrangement, or similar process for pre-authorizing common transaction categories. Different banks may use different names and different procedures. The idea is to identify in advance the kinds of transactions that are normal for you, such as car purchases, medical expenses, home improvements, family gifts, or other retirement activities. You can also identify a trusted contact whom the bank can reach if it has concerns before delaying a transaction. This does not mean giving someone else control over your money. It means creating a documented context so that the bank has a safer process than simply freezing first. If Martin and Carol had had that kind of arrangement in place, the car purchase might have looked less like a sudden red flag and more like a transaction category already understood by the bank. This is how risk management works. You do not wait for the bad event. You design the process so the bad event is less likely. The deeper point here is that financial freedom in retirement is not just about having money. It is about being able to move money when you need it. A person can have a large bank balance and still be vulnerable if the system delays access at the wrong moment. A surgery date does not always wait for a compliance review. A car dealer does not always hold the vehicle. A contractor does not always keep the price open. A family emergency does not always fit inside a bank's internal process. So the lesson is not fear, the lesson is preparation. If you know that the modern financial system reacts strongly to unusual patterns, then you manage your patterns, you give context early, you avoid artificial splits, you use cleaner transfer methods, you separate activity by purpose, you keep records, you build bank relationships before you need them. That is not paranoia. That is operating rationally inside a system with known rules and incentives. One of the biggest mistakes people make is assuming that innocence protects them from inconvenience. It does not. Innocence matters if you are defending yourself, but if your money is frozen for 72 hours, innocence does not make the car dealer wait. Innocence does not remove the stress. Innocence does not recover the time. Innocence does not stop a report from being filed. Good systems are built to prevent avoidable problems before they reach the point where innocence has to be proven. Another mistake is assuming that a report means you did something wrong. That is not true either. Many reports are routine. They are part of how the system works. You do not need to be afraid of a legitimate transaction simply because it crosses a threshold. The danger comes when fear of the report causes you to create a pattern that looks like evasion. That is the wrong response. The right response is to be transparent, documented, and consistent. Move the money for the real reason, keep the record. Let the compliance system do what it is required to do. Do not try to hide inside smaller numbers. When I look at this from the perspective of principles, I see a classic mismatch between old rules and new realities. The old rule was built when $10,000 was a very large transaction. The new reality is that $10,000 is a normal threshold in retirement life. The old system relied more on human judgment. The new system relies more on algorithms, reports, databases, and liability management. The old customer thought the bank relationship was personal. The new bank sees the customer through a compliance lens. None of that means the system is evil. It means the system has changed. And when reality changes, your behavior has to change with it. If you keep operating with the mental model of 1970, you will be surprised by 2026. That is true in markets. It is true in debt cycles. It is true in geopolitics. It is true in banking. People get hurt when they use yesterday's rules to make today's decisions. So here is the practical reality. If you are over 60, or if you help someone over 60 manage money, you should assume that large, unusual transactions may be reviewed. You should assume that repeated under-threshold transactions may be interpreted badly if they are not documented. You should assume that digital payments are part of the reporting world. You should assume that businesses receiving large payments have strong incentives to file forms about the transaction. You should assume that the $10,000 number is not going away and is not being adjusted to match modern prices. And then you should act accordingly, call ahead, document, use direct transfers, Do not split payments to dodge reports. Separate personal and business, like payment activity. Ask your bank about senior protection procedures before you need them. This is not about being afraid of the government or afraid of your bank. It is about understanding that large institutions do not operate on trust alone. They operate on rules, incentives, software, and liability. You can complain about that or you can prepare for it. Preparing is better. The retiree who does nothing, who assumes the old rules still apply, who moves money casually, who splits transactions because it feels safer, who keeps no notes, and who waits until the teller says no before creating a plan, is the retiree most likely to experience the system at its worst moment. The retiree who understands the system is different. That person calls before the withdrawal. That person keeps a record. That person makes the real transaction in the real amount. That person uses the appropriate payment rail. That person asks the bank how senior transaction reviews are handled. That person creates context before suspicion forms. Those two people may have the same amount of money, but they do not have the same level of control. And in retirement, control matters as much as balance. I want to end with the central principle. A rule that has not changed in words can still change in consequences. That is what happened with the $10,000 threshold. The number stayed still. The world moved, prices moved, banking technology moved, reporting moved, digital platforms moved, enforcement tools moved, bank liability moved, and retirees found themselves inside a system they did not know had changed. You do not need to panic, but you do need to update your mental model. The safest person is not the person who tries to stay invisible. The safest person is the person whose legitimate activity is clear, documented, and easy to explain. That is the whole point. When you move meaningful money, make the purpose visible before the system misreads the pattern. When you make a large payment, do not break it into pieces just to stay under an old number. When you use digital platforms, understand that convenience does not erase reporting. When you pay a business in cash or cash-like forms, understand that the business may have to report you. When you are a senior account holder, understand that the bank may have the power and incentive to delay unusual transactions. And when you see all these pieces together, you can see the system clearly. It is not one rule. It is a network of rules. It is not one threshold. It is a set of thresholds, incentives, databases, forms, and reviews that now touch ordinary retirement life. That is why the old $10,000 bank rule feels much worse today, and that is why the right response is not fear but preparation. Because the next time you need to move a meaningful amount of your own money, the worst time to learn the system is after the bank says the transaction is under review. The best time is now, while you can still build the process calmly. That is how you protect yourself. That is how you protect your family. And that is how you keep control in a world where the rules have become much broader than most people realize.